In some ways, that's a question I think that you have to ask the board, but I can hazard a guess as to why they appointed us. The first thing is that the board conducted a review process about whether to stick with the value style, and the answer that they came up with was that yes, they definitely should stick with the value style. And once they'd taken that decision, actually it put us in a very strong place, because there aren't that many value fund managers left in the UK market today. And I think myself and Nick are one of the longest standing partnerships. We've been running money for about 30 years. We've been working together for about 14 years. We have a tried and tested value philosophy that we've implemented throughout that time, that over the long run has delivered very good results for our investors. And I think undoubtedly those would have played into our favour. And I think the final thing probably would be that they liked RWC as a company. RWC is a small boutique company in which fund managers get a lot of autonomy and don't get a lot of the constraints that maybe you would get with larger asset managers. And I think that was something that really appealed to the board as well. The answer to that question is it's changed quite a lot. I think it's worth saying that we didn't inherit the trust from Al Mundy. He actually left in about February of 2020. Two other managers took over. They then actually put through quite a lot of change themselves. They did about 50% turnover. And we then inherited the trust in November. And we have probably put through something like 70% turnover. And so if you look at the trust today, it's very heavily weighted towards sectors like energy, miners, financials, and consumer cyclicals. And I think it's worth adding that those changes have been rewarded quite quickly. So since we took over, those have been very, very good performing sectors, and the trust is up something like 44%, I believe. This is always a tricky question to answer, because I don't think I've ever seen a fund manager who isn't bullish on his own asset class, and I'm going to be bullish on my own asset class. But hopefully I can back this up with some statistics. If we start with the UK market, we have data showing that the UK market over the last 50 years has traded at about a 17% discount to MSCI World, and today it's at a 45% discount. In fact, it's the widest discount since the early 1970s. So you're getting the chance to buy the UK market at an enormous discount to the rest of the world stock market. So that's the first point. We think UK equities are very cheap. The second point, I suppose, is value versus growth. And again, we have data to show that value is trading at the biggest discount to growth ever. So bigger even than in 2000 at the height of the TMT bubble. So you're being offered this fantastic opportunity, to buy some really, really cheap equities at the moment. And I think the final thing that I will say is that it does look like we are in 2021 anticipating some sort of reflation in the economy. We're anticipating an economic recovery. And of course, the sectors that the UK market is heavily exposed to, and value as well, so things like energy, materials, financials, are sectors which should do very well in that sort of environment. And for those reasons, I'm very favourable to UK equities. I think the thing that really differentiates us is that we are one of the last remaining investment trusts with a truly distinctive value style. I think we all know that a few years ago, lots of investment trusts had value styles, but value didn't do well over the last few years. And unfortunately, a lot of boards took the decision to terminate those managers and have shifted across to more growth-oriented managers. To their credit, the board of Temple Bar didn't do that. They have retained a strong value style, and it looks like they've taken that decision just at the point that value is coming back into favour. So I think that's a real differentiating factor.